Hello and welcome to the October MENA market briefing. And what a difference a month makes. My name's Timothy France and I'm flying solo on this occasion. But today I'm going to take a look at crude benchmarks and price spreads and global fundamentals in the context of OPEC policy. So stay tuned. Now, September was a very good month for crude oil bulls, and October appears to be shaping up in much the same way. When we looked at crude benchmarks a month ago, the core expectation was that crude prices would reject resistance levels and remain in the 65 to 75 trading range. In hindsight, that was an underestimation of a few critical fundamental factors. Gulf of Mexico production outages went on far longer than anticipated. OEC demand outperformed, and the pandemic risks that spooked the market in August ultimately failed to materialize. There's also the issue of OPEC incapacity. For a long time, the focus has been on production constraints and oversupply, so much so that the ability of producers to ramp up production was overlooked. Now we're seeing that underinvestment is actually impeding the ability of some producers to ramp up production. As we will see, there is spare capacity, but tapping into those reserves are not only a matter of flexibility in upstream infrastructure, but also of political will. Now, OPEC Plus decided not to increase production for November, and this has added to the bullish momentum we're currently seeing in crude futures. The top chart here is WTI, and the bottom chart is Brent futures. Now, we've zoomed out the monthly charts because the market is now hitting long-term technical levels. At the beginning of October, WTI made a new 7-year high when it broke the $77 level. Brent has been consistently making 3-year highs in recent weeks, and it will hit a big resistance level at 87, but we're still $4 away from that. Now, there's a lot of excitement around crude prices and questions over $100 oil, which seemed almost mythical only a few months ago. But rebounding demand, cautious OPEC production policy, energy crises in Asia and Europe, upstream underinvestment, these are all fueling a narrative of a new super cycle for oil and as well as commodities in general. This is the commitment of traders data for ICE Brent futures. And this is the managed money net position. If you look at the orange line, we see that hedge funds are holding 329,000 Brent contracts as of the print on September 28th. Now, this is important because speculators actually build positions as the market was coming into long-term technical resistance levels, and as well as we've got significant event risk ahead of OPEC Plus meeting in October, whereby the exporters themselves were facing quite significant political pressure to increase production. So that may have been considered somewhat of a risky position to take, but those bets certainly seem to have paid off in the short term. Now, bear in mind that net longs are, on a historical basis anyway, still relatively low at 50% of historical peaks. We still have to wonder if more hedge fund money will come into the market as commodities are spoken about in the form of a good inflation hedge. And we'll also see if they start to buy into this super cycle thesis. But there's also another aspect of the equation, and that's open interest. And as we see here, commercial oil producers in their positions. We see the orange line here shows that they are net short at 388,000 contracts. Now, is there still incentive to sell more? We are hearing about losses on producer hedges in recent months due to the rising prices, and this may create some reluctance to sell into a rising market. And the reluctance to sell may also be taken as a bullish signal that prices may go higher. So here we have the EIA forecast for global supply and demand, and this is taken from the monthly short-term energy outlook. What it shows is that markets are on a path to normalization. However, this is not going to be a smooth transition by any means, and that's the reason why I've duplicated the charts here. The two charts side by side show EIA forecasts between August and September. The agency made a massive revision to its third quarter 2021 data, which essentially flipped the market from a narrow oversupply to a steep 1.8 million barrels per day supply deficit. Now, the reasons for the revision include Hurricane Ida, Mexican offshore outages, as well as, quote, lower expected production in several non-OPEC countries. However, if we break down the third quarter miss of 1.8 million barrels per day, we see that OECD supply was lowered by 320 KBD, which is 20% of the adjusted volume, and non-OECD supply was lowered by 1.47 million barrels per day. That's 80% of the adjusted volume. Now, of that total, OPEC accounted for 888 KBD, and that's 48% of the miss. I think this adjustment underpins a few things. Firstly, that market tightness is creating susceptibility to unplanned supply outages and price spikes, and also that forecasting OPEC reduction, despite clear policy communications, is still no easy business. The September outlook indicates that market is tilting into more of a supply and demand balance over the next 6 months or so. And this does actually chime quite well with the comments that we heard from Russian Energy Minister Alexander Novak following the OPEC Plus meeting, whereby they perceive the market to be relatively well balanced, and thus there is no need for quota changes, at least for November. The October report for the EIA is coming to us just around the corner, so we'll see if we have any more adjustments in store. So now to take a look at sort of fundamentals in isolation, and we'll start with the COVID snapshot. The main takeaway here is that the third wave is subsiding. As we know, global markets got nervy in August as cases started to peak again, and fears over the spread of Delta variant sort of started to mount and get into the heads and psychology of traders. However, those fears, and particularly fears of further contagion in the Far East, have more or less failed to materialize. Meanwhile, we've got the Delta variant, which has driven the latest case surge in the US. That also now looks to be fading. So overall, we've got progressive vaccinations and booster programs, as well as effective management policies. These all seem to be achieving a diminishing economic impact with each subsequent wave of COVID. You know, there's a final note, I suppose, heading into the Northern Hemisphere winter, is that maybe there's concern of spike in case count as a result of seasonality there. Moving over to the supply side, this dashboard is taken from our monthly OPEC report. It gives a snapshot of September reduction versus pledged production cuts. Now, as a collective, OPEC marginally overproduced in September, cutting 95% of the target. Now, I want to critically reference the bottom row here, and that shows that Middle East exporters are cutting far less than pledged. Saudi hit 75% in September versus 80% in August. UAE is 74% versus 80% in August. Now, we may well expect that gradual erosion of compliance to continue as per OPEC policy to bring barrels back to market. Now, in the context of volumetric impact, it can be easy to overlook West African producers. However, overcompliance is becoming quite important in the context of rebalancing. Now, there is a lot of talk now around the inability of Nigeria and Angola to increase output due to underinvestment. That would mean fewer barrels available amid rising demand, and more specifically, fewer light sweet barrels for delivery to Europe. And this fact, combined with geopolitical risk in Libya, lends some considerable upside risk, you might say, to the Brent benchmark. And that's particularly true relative to WTI, which could be impacted by rising rig counts in the US. And then you've got Platts Dubai, which could be impacted by rising Middle East production. Now, while some OPEC members are struggling to raise output, the EIA data indicates that there is actually still ample spare capacity to meet global oil demand. This chart to the right, you see, heading into the fourth quarter of 2021, the EIA estimates that OPEC has a roughly 5.1 million barrels per day in spare production capacity, which accounts for 5% of global demand. Now, that volume should be sufficient to cover any structural supply deficits that may evolve from underinvestment, at least in the short to medium term. How willing or able OPEC members are to bring this back to market is another matter entirely. Moreover, the speed with which reserves can be tapped into may not mitigate upside risks stemming from short-term immediate supply shocks, such as the Gulf of Mexico outages we saw recently. And that's particularly acute with global inventories now so low. So these market conditions, you might argue, bode quite well for market share or OPEC market share going forwards. Now, in terms of crude exports and barrels to market in the short term, we see that Middle East producers are starting to increase export volumes, which are now back in the 5-year range as producers start to relax production constraints in line with OPEC guidance. And that trend does support the case for fundamental normalization of global oil markets. And we'd expect that trend to continue over the next quarter. So finally, as mentioned, incremental supply gains are most likely to arrive from the Middle East and from the US. And this could create downward pressure on Dubai and WTI benchmarks relative to Brent. Now, the price data here shows swap chains for Brent Dubai EFS, which is in the yellow, and for Brent WTI spread, which is in the red. Now, both price instruments show that Brent is expected to narrow its premium to the US and Asia benchmarks in the coming months, suggesting that the current strength we're seeing is not necessarily sustainable, at least in the near term. Now, bear in mind that the picture is somewhat complicated by market structure, but suffice to say that the markets are pricing a reversal in fortunes, at least for WTI, from February 2022, when the forward curve in the swaps suggests that the Brent WTI spread, having narrowed for a period, will then start to widen again, and that could relate to expectations surrounding US production. So those are some of the key highlights from the Middle East and what we're seeing in the market presently. And we hope you'll join us again next month for another update.